Hello, I'm MaryAnn. The U.S. jobs numbers came in at 288,000, a really good number. But there's always a complication. A good number means the U.S. economy is doing better, and that suggests the U.S. Federal Reserve could start raising rates sooner than expected. And if rates go up in the U.S., odds are Canada is not too far behind. So what does that mean to mortgage rates? I'm asking James Marple, senior economist at TD Bank Group. What did you think when you first saw the numbers today?
Well, it was a really good number. We were kind of jumping out of our seats. The consensus was for about 215,000, so well above. Way above that, and starting to push close to that 300 mark. So a good number, and on top of that, you had good revisions. We added even more than previously thought to the last month, and in April actually, after the revision, above 300. So a pretty obvious acceleration in growth, whether you look at it on a year-over-year basis, the 3-month moving average.
What's normal?
Well, normal, this recovery for the last 5 years has been running about 200,000. So, and it's been pretty steady around that. Obviously, there have been some up and downs, but this is clearly much above, and actually has been for roughly the past 3 months.
Now, the unemployment rate we've seen declining to 6.1, and now a lot of the time we've seen a decline due to a shrinking pool of people actually seeking for a job rather than more employed people out there. What happened this time?
Well, this time it was pretty much all good news. Household survey employment went up over 400,000, and that was largely responsible for the decline in the unemployment rate. So it was a pretty good news story. You did see, as you mentioned, the labor force participation rate remained steady. It fell slightly to 2 decimal places, and it is at a low that we haven't seen since the 1970s. So we're hoping to see that rebound at least a little bit going forward. But seeing that job growth, I think, is paramount, and we did see that both in the payroll number and in the household survey number.
Now, what about wages? Because we've seen wage growth kind of be meager at best and a bit in line with inflation. You might say about 2%. Should it not be higher?
Well, it should be higher because that's nominal wage growth, so that implies that really we're seeing no wage growth above inflation. So workers on average aren't actually seeing any real wage gains. So that should start to improve. Now, in fact, I think that's a really important indicator for the Federal Reserve. In fact, Janet Yellen in her speech this week even mentioned it. She's mentioned it several times as something that we need to start see the job growth turn into to faster wage growth. So I think that's something that is going to determine even how the Fed reacts to the good job numbers.
So do you think, we're looking for interest rates to move, do you think anything that happened with these numbers is going to change Janet Yellen's perception and what she does?
Well, certainly more positive economic data on balance should move the Fed closer than later. But it's interesting because we see actually a bit of mixed economic data more broadly. The GDP numbers for the first quarter were abysmal after the final estimate. You're seeing obviously much stronger job growth, a number of other indicators I think pointing towards acceleration, but still some weak wage growth. So I would say on balance we're still comfortable with our view that the Fed will remain on hold through this year, probably through the first half of next year, in that it will be in the second half of next year before we see the Fed start to move. But that doesn't mean that we won't see longer-term interest rates, longer-term bond yields start to rise. In fact, I think that's already has begun over the last couple of weeks, and I think will continue, especially as the economic data continues to improve. And we think we'll see probably in the United States a 40 basis point or so increase in the 10-year yield. Similarly, maybe slightly less in Canada, just because the expectations for the Fed are moving more forward. But still, I think we're in an environment where interest rates should be moving up, and that's a good thing because it's coming alongside faster economic growth. So
then, could this affect our mortgage rates and renewals coming up?
Well, I think it will. I mean, I think we're pretty much a low point in terms of where mortgage rates are. They've kind of went the reverse direction as expected over the first half of this year. So a lot of that was, again, that disappointment in economic growth, especially stateside, and having some of that now in the review and having multiple signs that growth is accelerating, gaining speed. A lot more talk that we're with this kind of job growth pushing above 250. You're getting to really really a self-sustaining recovery, one where, you know, continues to feed on itself and gain strength. And I think that is an environment where we'll see more of an ongoing increase in rates.
So mortgage rates, definitely something we'll keep our eyes on. Thanks for coming.
You're welcome.
I've been joined by James Marple, who is Senior Economist at TD Bank Group. Thanks for watching.